preferred equity in the current state of things. So the quote here, and it's a little bit lengthy, but I think it's worth it here.
People are talking about preferred equity?
Oh, I think so. I think so. This is at least, and again, like I sometimes feel like my own biases and the discussions that we have at Gray Capital affect the news that I gather. But dang, if every week the stuff we talk about,
I'm just giving you insight.
the stuff we talk about comes up in the news, like we're basically predicting the future. So it's good to know. I think that I'd rather think that than I am guided or biased in any way. But what Cushman says about preferred equity, they said compared to senior interest rates borrowers were able to obtain prior to 2022, preferred equity may at first seem expensive. However, the cost of preferred equity has not changed meaningfully over the last year, while senior interest rates have continued to rise. In the case of agency loans, the borrower has the choice between preferred equity behind a Freddie Mac or Fannie Mae loan. Freddie Mac preferred equity includes a hard current pay, which includes the pref investor additional rights and remedies in the case of missing a hard current payment. Now, I'm not really sure what that means, but that's
oh man, we got some work to do.
That's a little bit in the weeds. Now, Fannie Mae preferred equity is mostly soft current pay, meaning that any missed portion is capitalized and accrues without penalizing the borrower. There are fewer Fannie Mae preferred equity investors since many are focused on the rights and remedies that come with a hard current pay structure. So my guess is I don't know, they like Freddie Mac a little bit more. However, there are plenty of Fannie preferred equity options, and there's little differentiation between Fannie and Freddie preferred equity at the margin. They're taking on.
When you're saying Fannie and Freddie preferred equity, are you saying this is preferred equity provided by Fannie and Freddie, or are you talking about the preferred equity that they will allow to go in a subordinate position to their?
I believe that we're talking about Fannie Mae and Freddie Mac preferred equity. It seems like Freddie Mac preferred equity includes a hard current pay. So Fannie Mae and Freddie Mac are these large lenders, and they are now entering into this preferred equity instead of maybe LPs going now. And how many banks are going to be going into a preferred equity?
And that's the thing, banks really can't. They're banks.
Yeah,
they're not equity investors.
Okay, so how can Fannie Mae and Freddie Mac get away with it?
Well, they're not a bank.
Okay, but they're a
lender.
It's okay. It's still
they're quasi-government, quasi-governmental.
They do what they want, I guess.
Entity.
Yeah.
No, the preferred equity is coming from our non-bank lenders, mezz shops, preferred equity groups.
Okay.
And I have, and that's where I don't, again, I could be wrong. Freddie Mac, from my understanding of like recent discussions, like today, Freddie Mac is exploring being able to offer preferred equity.
Okay.
But they're not yet. I think this Cushman Wakefield this is an advertisement for Cushman Wakefield's preferred equity offerings that can go behind. Agency debt in the agencies, because preferred equity can appear in a couple different forms, and sometimes it can appear more like debt. Sometimes it can appear more like actual equity that's kind of just like capped. There's a lot of flexibility in preferred equity, which is why borrowers are interested in it to fill gaps in their capital stack, because you can have the total pay, but then there can be a certain amount that's paid, upfront, like a preferred return, like 8-10%. And then, but the total, coupon or the total actual payment may be 14-15%, but that difference just accrues to the back end to when the preferred equity position matures. And it can be 1, 3, 5 year, terms. There can be teeth that goes along with the preferred equity. So there's a lot of different varieties, and the agency, Fannie Mae and Freddie Mac, both have very specific ideas of what that subordinate debt or that subordinate capital looks like, because they don't necessarily want you to be bringing on additional debt. They want to keep the loan to value a certain range, so it has to look a certain way. So they're like, okay, that's just equity.
Yeah, I don't know enough about the Freddie Mac and Fannie Mae offerings when it comes to preferred equity, but it does seem like, apart from my recitation of all like these terms and stuff that I don't quite understand, but it does seem like good evidence that an increasing number of institutions are are interested and involved in preferred equity, and I think that it is particularly interesting that it's on Freddie Mac and Fannie Mae's radar. And why would they even offer? They're like the ones that are offering the big loans. Like, what is their,
So they got borrowers with gaps.
Yeah.
And so they're specifically, and the piece that we're looking at right now, again, it's Cushman Wakefield piece. Cushman Wakefield and Greystone have had a closer and closer relationship.
Mm-hmm.
They have a partnership. There's been talk of a merger. Probably not right now because the values are down, so the merger's off. But there's definitely a relationship. And this piece, it's essentially an advertisement for Cushman Wakefield, but also Greystone and their new offering.
Okay.
And so and I know this is cut off, but I'll read it real quick so you don't have to. Essentially, it says Greystone announces equity platform utilizing Greystone balance sheet. While we're permissible as well as market relationships provide third-party equity and preferred equity solutions to Cushman Wakefield Greystone clients. You got to get in touch with somebody, but they're seeing is this gap in the market where they're trying to close deals, and there's an equity gap.
Yeah.
People can't raise the common equity.
The need is there.
The need is there, and so you're seeing more and more participants. And Greystone is getting into this space specifically. Freddie Mac is figuring out how to do it, and we're getting into this space also, Matt.
Yep.
We're looking at deploying preferred equity for a variety of reasons. We have the ability to do so, and we see a really interesting sweet spot to get invested into real estate, but earn a higher return with actually taking less risk.
Yeah.
And Gray Capital, we're in a unique position of where we have the capital available, but we're also an operator. So, in cases where, something doesn't go, the right direction and, the asset becomes distressed, if need be, when we're working with the sponsor group and the lender to create a, win-win solution, but we have a variety of tools that we can use to kind of come in and kind of right the ship and get things moving that, some, lenders or private equity, pref equity investors, they may not have those resources or capabilities. They're really just looking at it from they're really acting as a lender and just in a different kind of risk profile from maybe a different investor base. And so we've been talking about this gap for a while, that there's going to be a shortfall, the loan maturity. You don't know, you're not coming back enough money. What are you going to do? You need to fill the gap. You go back to your investors. They may have no interest in meeting your capital call. They might not have the ability to meet your capital call. You may not want to ask your investors to make a capital call. And so people are shopping for, additional solutions that are flexible. Again, that's what's interesting with, preferred equity. So like if someone brings us a deal, we can size it to where, what the cash flows from the door, what can the deal support in terms of new capital? And we can figure out what that payment is. And then we can accrue the rest of it on the back end. So it's like, things are going to ideally improve in 3 to 5 years through a refinance or a capital event or a sale. It gives you the time, but, the preferred equity is capped. So we're taking some of our upside off the table and saying, just the total pay is, 14, 15. You're only going to pay us, 8 to 10, along the way. The rest of it comes when you sell a refinance. They don't have to pay that full boat, but then to our investors, we're getting compensated for the risk. But the total returns to our investors are higher than a lot of other deals we're seeing in the market right now from common equity. But if you're a sponsor that says, "Hey, this deal is awesome. I'm gonna hit a 20 IRR," which I think is really hard to do in this market, but people are saying they can do it. Okay, well, if you think you can do it, then we're capped at 15. That additional 5%, that flows to you and your investors. So you get more upside. Maybe that 20 turns into 22, 25 or something. Probably 22. But so it's much more flexible than just like a mezz loan, which is like always a hard pay. And it's just a loan. Here, it's 9% interest. I need 9%. Versus a pref equity, it's like we can get down to 6%. Or we can maybe 5%. Now there's going to be more on the back end. There's a lot of different ways to structure it that can work for a sponsor, not kill the deal, allow them to fight to win, live to fight another day.
I'm just imagining all the regulations that you could apply to those. The flexibility.
No regulations, Matt. We don't need anyone.
Well, all these options, every single thing that you said, whether it's on the back end or the front end, and all of the flexibility that is being exercised right now for people to help.
Don't do that.
We can't do that now. We got to regulate that.
No. Fortunately, we're not the size of Blackstone just yet, so I don't think we're not in the crosshairs.
Yeah.
And the non-bank lending stuff, they're really just talking about the big guys.
Yeah.
And like specifically Bridgewater and Blackstone and probably some similar firms.
Yeah.
So I think we're in the clear. But don't give anybody ideas, Matt, please.
I love a good regulation.
I love a good regulation. It's just it doesn't seem like it comes from the federal government ever.
Yeah. Even on the I understand. It's easy. It's easy for me to understand. Like, okay, there's always like a good intention to some of these regulation, but man, for some of these that are the one that we kind of discussed today, it's a little too easy to see through it. And I don't know, maybe more pain will come. And the more stories we hear about investors getting burned, this story about regulation may continue to percolate and may continue to develop. So
yeah,
keep an eye on that.